going on, everybody? Good morning and welcome back to Beat the Bell presented by King Capital. Happy Friday. I hope you guys have all had an awesome week. Let's get into today's show, starting with Money Mander. Good morning.
Let's get into it. Happy Friday. Wild week coming, and we'll see what we get today. See if the rally continues.
All right, and Diamond Trades.
Good morning. Happy Friday. Let's get after it.
Let's do it. Fed forecast and economic calendar.
I think we have Stock
Snipa.
Snipa.
Stock Snipa's here. Stock Snipa. Good morning to you.
Yeah, I'm about to say, what the hell, man? Good morning. I'm back in the U.S. It feels amazing to be here after being trapped in London for about 30 hours. God bless America, dude.
All right. Well, it's good to have you back. All right. Now, Fed forecast and economic calendar.
Yeah, let's do it. Let's go ahead and dive into the data that we just got. We just got PCE, which came in. I'll have those numbers for you in a second. PCE month over month came in at 0.4% versus the forecasted 0.5% and the previous 0.2%. The PCE index on a year-over-year basis came in at 3.5%, which was in line with expectations and a slight uptick from last month. These core PCE prices are really what the Fed likes to focus on when they're looking at inflation. There you can see the market reaction. We got a nice pop on the S&P initially after that print. Today we still have some data. We have Chicago PMI coming out at 9:45, and then Michigan consumer sentiment at 10 o'clock, as well as a Fed speaker at 12:45. And that'll wrap up this week's news. We've had a ton of news this week, so let's go ahead and cover it for a little bit. We had on Wednesday, we had durable goods come in at 0.2% month over month, which is pretty much in line with expectations. No, it was not in line with expectations. 0.2% month over month was a beat of expectations, and so that's actually showing stronger than expected durable goods orders, showing that the economy remains resilient even as people look for a bit of a growth slowdown in Q4 of this year and Q1 of next year. Durable goods did come in on a month over month basis higher than anticipated. GDP on Thursday came in more or less in line with expectations, 2.1% versus 2.1% expected and the 2.2% previous. So that's the GDP growth for this third quarter, which comes to an end for the second quarter, rather. The third quarter comes to an end today. We'll have those GDP numbers out in about a month or so. Like I talked about before, economists and even the Fed really is expecting a bit of an economic slowdown as we come into Q4 due to several factors that we covered last week. You know, the UAW strike, you have the resumption of student loan payments. Obviously, yields have been squeezing, basically sitting at year-to-date highs. And so that's sort of the expectation for the economy going forward as we head into Q4 here. We'll have to see how that plays out. Let's go ahead and dive into this week's trading. The market has shown strength over the past 2 days, countering the downtrend that we've seen in the indices over the better part of the last 2 months. So on Thursday, the NASDAQ closed up 0.8% with the S&P adding 0.6%, both good for the strongest day trading days in over 2 weeks. The Dow added 0.3%. We've talked a lot about higher yields and a stronger dollar being headwinds for stocks. Yesterday, the rally in yields paused with the 10-year closing just below 4.6, down more than 0.5% from Wednesday. Dollar index retreated to the 106 level, down 0.75% from its high on Wednesday. While both the dollar and the yields are still sitting within spitting distance of their year-to-date highs, the pause in that strength that we've seen in both the dollar and the 10-year yield has been a much-needed breather for the stock market. Obviously, yesterday we had a super aggressive rally across the board with really all indices trading higher. So that is definitely something to pay attention to as we head into the fourth quarter. We're going to see if the dollar and yields want to continue their rally. And again, we would expect that to put additional downward pressure on stocks. This week's price action has produced a ton of volatility and some nice upside opportunities, but those betting on a sustained bounce should not get complacent. Over the last 11 trading days, all 5 up days have been in the bottom half of volume, including yesterday's monster move. All 6 down days have been in the top half of that 11-day stretch. And as far as volume goes, it shows a bit of a lack of conviction on the part of bulls to take things higher with force. So that's definitely something to pay attention to as well as we head into Q4, which will start on Monday. Mander, what do you got?
Really great segue here because I want to get your opinion here at the end when we come to it. But looking at as we kind of end Q3 here, first red quarter pretty much since a full trip around the sun, going back to last Q3 of last year before pretty much lows were set in October. And we had a really sustained rally for 3 consecutive quarters there. But looking at the S&P where it kind of bottomed on Wednesday, I'm kind of curious to get your take at the end of this. If we do get a sustained bounce here off those lows and that hammer candle that we set on Wednesday, or continue to move lower into October. Because as you mentioned, that's really a big thing is that the rallies we've been seeing over pretty much all of September have been on significantly less volume than the sell days, which leads to show it's pretty much just shorts covering as, they're getting oversold versus new longs kind of entering in and buying the dip. And coming out of last Wednesday's FOMC meeting, we can pull up this chart here. That's really where this all stemmed. Obviously, seasonality led to September being weak before the meeting here. But then the Fed raised forward guidance for rate projections into the end of 24 and 25 by 50 basis points each, which basically called off 4 rate cuts that were priced in over the next 2 years, and now upped that to 8 since March because they raised both of those 50 basis points in March. And that's really what led to this massive squeeze we were seeing in yields, which is obviously the biggest negative headwind on top of anything else, any other type of sentiment. This is a direct fundamental headwind coming into the stocks and really valuations where they're trading at. The 10-year just ran 35 basis points since this meeting here, a massive overreaction to the upside as we kind of got this unexpected news. And that's typically what happens. You get a knee-jerk reaction to one side before things finally reprice and get to their new equilibrium and kind of comfort spot. So as you mentioned, yesterday we got the first simultaneous red day in the dollar and yields pretty much since the meeting last Wednesday, which kind of stemmed off of that massive intraday reversal we got on Wednesday and then led to the rally we saw for continuation to the upside. And it looks like we're getting even more in the pre-market here. But I think the bigger thing is over the coming days and weeks. Obviously, yields being up 35 basis points from where they're already at into new 15-year highs pretty much every other day here in the 10-year. It's going to discount future earnings aggressively, and especially at the premiums, the multiples that stocks are kind of trading at right now, it puts us in a really interesting junction. At the same time, the S&P 500 just got a really textbook bounce off of the trendline support going back to those October lows. So pretty much every low we stemmed there in October, in March when we got the pullback off the banking pullback and the fallout of those 3 ones. And then pretty much this pullback now in September off the yields running, all of them pretty much held support at the same point. But at what time do we get into with seasonality, with volatility typically having your annual run going into October and September, October being, the weakest months of the market? Do we start to see these fundamental support levels start to roll over? And then at what point, if we get Santa rally, at what point do then we really start to look for extended downside, not just a corrective move like we've been seeing?
Yeah, I mean, even just like looking at a chart, I mean, I don't necessarily believe that we've put in sort of the low of the second half of the year. I do think there is a little bit more room to the downside that we could go. But at the same time, I mean, I guess it depends how you're looking at it, right? Like for me, I've sort of separated it into 2 baskets where it's like every time that we aggressively sell or make new lows, like for the long term, I'm buying, right? Like that's just sort of been my game plan. And that's literally what I did on Wednesday, right? We sold off, we were selling off for basically the entire month, and every month I'll buy a little bit. And so Wednesday, that was my purchase for September. And then October, I'll do the exact same thing, right? As far as trading goes, like intraday trading, I really don't think that it matters a ton in terms of like whether that was the low for the rest of the year or whether we're going to trade lower. I do think that the good thing for us as traders is that this week in particular, we've seen a ton of volatility, a ton of range. I mean, NQ had like a 250-point move yesterday. So there's definitely a ton of intraday range for intraday traders to make their buck. And as long as that continues, I think that's just really going to be a benefit for those intraday traders. I think what I would get concerned about is if we lose some of that volatility going into the end of the year, which I really don't expect. I mean, things have gotten pretty volatile over the last 2 weeks. Like maybe it won't be this volatile, but as long as there's some volatility for us to, make our intraday moves and get in and get out, I think all will be right in the world. As far as long term, like I said, I think for me, it's just buying dips. So that's sort of my game plan.
I'm in the same camp, and it's worth mentioning exactly like you said. September 1st pretty much set the high at the open of this entire move down. All of September was continued downside. I think depending on where we close today, S&P is on track to close the month down 5%. So definitely pretty much overdue here for some type of short covering and a relief ballot. But we'll see where that goes from there. Do we then rally into new all-time highs or get a pop and then come back down into new lows? We will see.
Yeah, good points. This is the worst on track anyways to be the worst month so far this year. So we'll have to see how we rebound from that. That'll wrap it up for Fed forecast. Pass it back to Alejandro.
All right, guys, let's take a look at the system. So yesterday we did get a buy signal on the 30-minute chart. The bullish cross at the 10 SMA over the 50 SMA. Now the 50 SMA on the 1-hour chart becomes a key level of resistance for bulls to watch today. Definitely a bullish setup going into Thursday. A couple things to note. A lot of people were looking at the head and shoulders on the QQQ chart with the neckline sitting at around 353. We did dip below that, failed to break down. We recovered. That was obviously a very bullish looking setup. Same thing on ES. We got the failed breakdown with squeeze shorts. And of course, we were just deeply oversold. We've gotten a lot of selling. We've seen a lot of selling, and so the relief bounce was certainly due. And there was a lot of confluence there on why we got that relief bounce. We also had an inverse head and shoulders on ES. We bounced off of the bull market trend line going back to October on Thursday. So it does make sense that we're getting the relief pop. It's going to be interesting to see how much momentum this move gets. Today is now day 2 of the relief bounce, and we're a good 90 or so points off of the low now. So yeah, it's going to be important to continue to monitor using the system. Here's what I'll say. We did get the buy signal. We are trading higher in the pre-market. We haven't gotten that confirmation over the 50 SMA on the 1 hour, so definitely watch that. But if these moving averages start to curl up again, and if we can start to trade over these moving averages, that would obviously be a good sign as far as momentum is concerned for bulls, because they have not seen that for a very long time. We've been trading below the 50 SMA since September 15th on the 30-minute chart, and then we finally broke above it yesterday. But really, this 50 SMA on the 30-minute chart has been in a pretty steep downtrend for the entirety of this month. So getting that curl higher, watching those moving averages start to come up, visual representation of momentum in the market would be a nice sign that things are taking a turn for the better. So that's what to watch. That's what to watch in the S&P. Let's go over to Stock Sniper now for Bet the Bell.
Good morning, guys. It's time for the best part of the show. I know you guys are all excited. We have a little drum roll here, but Diamond Trades is in top. You can see he's sitting at 63 wins. Alejandro is trailing behind at 61 wins. We can see he's at a 68 to 66 win percentage. And Money Mander is at 48 wins at a 63% win percentage. Now, today I will catch my 40th victory, just for the record. But first question of the day, as typical, green or red? Alejandro, what do you got?
Green.
Green. That was a pretty quick answer. Diamond, what do you got?
Yeah, green I think is safe. I mean, we're up $3 on SPY in the pre-market, but we're coming into a gap fill, so you never know. I'll go green though.
Money Mander.
Green for sure. Green.
Yeah, I think I know what I got to say. Green. I mean,
I don't know, man.
No brainer at this point.
I will say the last 2 or 3 times I believe that we were all on the same side, we were wrong. I'm just saying. Just throwing it out there. That's all.
I would like to challenge that, but we'll see. I'm going to put this into my next interesting question. This is definitely a Money Mander question. But if you had $100,000 and you had to use it for a lotto, not the Powerball, not like an actual lotto, I'm talking a lotto trade, how are you going to use this $100K for a lotto? I'm going to go ahead and start this one off with Alejandro.
What's the timeline? What's the timetable here? Like how long?
You could buy a 0-day option. You could buy whatever you want. $100,000 has to be some crazy shit.
All right, come back to me.
All right, Diamond Trades.
Yeah, I'm going to go with I'm definitely going to go with one of the EVs. I just don't know which one. I'm going to go with Lucid. Lucid would be my lotto. Lucid is sitting at 553 right now, which I believe is all-time lows. You know what? I keep seeing Lucids in the parking lot of my gym. They seem to be on the come up. If it's going to be anything like Rivian, stock should explode. I don't know. I like them. I like the way that they look, and I think that they're probably like better actual vehicles than Teslas. Tesla definitely like more cachet with the brand, I guess. But yeah, if Lucy can like grab hold of a nice piece of the EV market, could see it squeezing. So I'm gonna go with Lucid.
Okay, I like it. Money Mander, you got something for me?
I got something even more rogue than that, but I do like Lucid, just to put that out there. It's not that rogue of a company. I think they're just having production issues, but here's my rogue $100,000 lotto I'm going to put in. I'm going to take the January $10 calls on Peloton.
Whoa.
I think this thing has seen the oversold of oversold. It's getting a pop here off the Lululemon, whatever deal they just came out with. They have some 5-year partnership agreement. Getting a pop here. I think Peloton could be in for one of those really aggressive short squeezes. Does it come back to $3 at some point? Sure, maybe. But I'm going to buy me some time, and I'm going to take some dated calls on Peloton here.
Wow. It's a pretty nice one. I'm going to have to go with, you guys might hate me. I know that Alejandro is going to make a little face or feel some type of way when I say this, but I'm probably going to go with the 1113 AMC $9 calls.
Somebody was going to say AMC.
Yeah, and that somebody's me.
Why the 1113 calls?
For some reason, hang on a second.
You're feeling a squeeze before then?
Well, no, because I could just get more contracts, at that point, versus if I wanted to go towards that like December time era.
All right.
11/13 could possibly be the wrong date also. Again, guys, this is total BS. Don't. I mean, I'm not telling you don't buy it. I'm telling you don't do anything because of what I just said. This is total BS. Yeah, that's pretty much what I got for you there. Alejandro, you got something?
Yeah, I'm gonna go with like an exciting one. Also, like we're gonna be able to watch it today. Just limit order to buy. We're trading at 431. The 434 calls right at the bell. So just limit order. You place it before pre-market. You get filled right at the open, and you just watch those puppies rip. I think they'll double. I think they'll double in the first 30 minutes today. Yes,
434.
Yeah, so we'll watch. We'll see what happens at the open today.
Yeah, we'll see what happens. That's an interesting one. I like it. So, for my next question now, which this is kind of good news, I guess. I'm not really sure how to really take this, but we could see this tweet from Unusual Whales here. Roughly 1 in 15, or 6.5% of U.S. homes for sale had a price drop during the 4 weeks ending in September 24th, up from 5.8% a month earlier, per Redfin. So now we can see that if we did the difference between 6.5 and 5.8, we could still see that there is a 0.7% decline. Now, my question for you guys is this the start of a housing market crash, or houses looking to become more affordable in the near future? What do you guys think? How would you take this information? I'm going to start this one off with Diamond Trades.
Well, I think when you look at where rates are, you get a situation where people who recently bought homes and have attractive rates are reluctant to sell them, which I think was part of the reason that prices were up in the first place. And then you have the opposite effect for people who are looking to buy homes. Like with rates so elevated, you might have a situation where you would rather rent until rates come back down before you make your purchase, and so that your interest on your mortgage is not quite as high. So I think that that's probably what's playing out here, is that the folks who are in the market to buy homes are sort of being shied away by the fact that rates are so high, and that's having a chilling effect on prices in the housing market. Wouldn't necessarily call it a crash, but I think that as long as rates stay elevated, that's an effect that we could probably see stretched out into next year.
I like it. Great answer there. Money Mander, what do you got for me?
Yeah, I'm going to agree. I think this is an interesting one we've been talking about for a while. The big thing to watch here is unemployment rate, because with rates elevated, no one is looking to repurchase new homes and have to pretty much double their mortgage rate, probably from where they're locked in at from 2020, 2021, or before then. But the thing is, until unemployment upticks and people are forced out of their homes because of financial reasons, not being able to cover their mortgage, you're not going to see an excess of supply on the market. So pretty much everyone who's in their house isn't looking to sell it. It pretty much balances out people not looking to go buy. And so at that point, you're not going to have a crash until people are financially forced out of their homes. So maybe you get a little bit of a corrective move. Obviously, there's just a ton of lack of demand here. Mortgage applications and new mortgages are down like 95% over the last 2 years. But at the same time, until everyone is forced to have to move, I think you probably just see this, slightly correct, but I don't think we see a crash, like a 20% price drop, until we start to see unemployment rate up like 4.5% plus.
That's a crazy stat. Mortgage applications are down 95% in the last 2 years.
Wells Fargo got rid of like 90-something% of their mortgage brokers because there's just no applications right now.
That's nuts.
Wow. I'm actually shocked by that stat as well. Alejandro, what you got for me?
Yeah, I'm definitely in agreement. I think it's more of a choice thing. People choosing to sit out because interest rates are so high. And we've also been talking about, median rent prices in New York and how they're basically the highest they've ever been. And so it's still showing, people are choosing to rent versus buy. And Sal made a good point that, this isn't a case where people don't have jobs and they're not able to afford to buy a house. It's just people understanding that rates are ridiculous and there's no interest there to buy a home. So, yeah, I think it's more of a choice thing than, people being unable to continue to pay their mortgage.
Yeah. From one thing that I've kind of learned, more pertaining towards my area, in South Florida, everyone and everyone's uncle wants to be a real estate agent. If you ask me why, I can't really tell you. I think they just want to sit around all day, but maybe only 5-10% of them are actually making money. The other 90% are just Instagram bio real estate agents, trying to look cool or something.
Well, I think that sort of comes from like even like just the last couple of years, right? I think you have certain areas, Florida being one of them, Texas being one of them, areas of Arizona, parts of Tennessee where like you had a massive influx of buyers. And obviously if you were already a real estate agent, you sort of benefited from that if you're good at what you do. And it's sort of like the same effect, right? People see that and it's like, let me try my hand at it. It's the same thing as like when the market rips. It's like everybody wants to be a trader when the market's doing great.
Exactly.
Yeah.
Got a point. But now that is driving the home prices in South Florida up a bit. And again, there is too many sales associates and brokers to the available properties and buyers. There's a big discrepancy there. So that's one thing that I'm noticing, especially in this area right now. So I could definitely see, in the potential future, these home prices starting to decline a bit and kind of sales being made and everything going on, what it has to do. But that'll wrap it up for Bet the Bell. I'm going to pass it back to Alejandro here.
All right, guys, that's going to do it for this morning's show. Appreciate everybody that tuned in. Hope you guys all had an awesome trading week. We'll be trading live in the King Capital Discord. You can go to knashcapital.com or scan the QR code on the screen. Have a great Friday, everybody, and have an awesome weekend. We'll catch you back here on Monday morning at 8:30 a.m. Eastern Time.